session today. First, I'd like to welcome back to the stage our management team that you've already heard from today. They are joined by Laura Carpenter, our Chief Customer Officer, and Brian Tabb, our Chief Development Officer. As a reminder, in the room, you can scan the QR code in front of you, and online, please click Ask a Question in the top corner of your screen. We'll start with our first question. The medium-term outlook is 3 to 5% same-store sales, but the guidance for FY26 is for 4 to 6%. Can you elaborate on the difference? Is it conservatism, or is the business just stabilizing to lower organic growth?
Thanks for the question. As we think about the algo, it's important to us to set targets from an overall growth perspective that are solid but realistic and achievable. We have clear line of sight, as we said, to the high end of that range, and we're committed to doing everything we can to deliver that. However, we're also realistic about our maturing store base. We're realistic about the macroeconomic backdrop that we're in today. And while we see no reason to not be able to deliver on that at the high end, we want to give ourselves the flexibility and frankly, set, again, reasonable and realistic targets. In terms of the 4 to 6%, that's much more near term. And again, we see clear line of sight to deliver on that, and we're committed to delivering on that.
Okay, our next question is on margin expansion. Margin expansion can stem from 3 drivers. 1, same-store economics improve over time. 2, mix of franchise versus corporate. 3, as total company grows, leverage fixed costs in the margin expansion you laid out. What portion should stem from 1, 2, and 3? How should we think about the levers, and where is the most risk?
Overall, I think Lenny covered it well in terms of 4 drivers. There's one missing, which is just the car park evolution, which will drive some margin mix expansion. When you look at, that will drive a bit, but the most comes from the 3, I think, that were mentioned. Operational efficiency is driven by both transaction growth with a lot of the fixed overhead in the stores remaining constant. So there's margin as we continue to grow our mature stores in transactions. And just to remind you, in 2025, we grew our transactions across our entire network in Q4 and for the whole year in our mature store base as well as across the network. So we have a track record of continuing to do that. But that combined with the efficiency work around labor management and store operations, that will be a big chunk of the margin improvement. Our mix shift will drive naturally a good chunk, probably not as much as the efficiency on the operational side, and then SG&A. So I would say the bookends will drive the more meaningful, and then our portfolio will add to that as well as a car park. I would also just say that the 100 to 200 basis points of growth is a management commitment. We see line of sight for higher than that. But we also want to be a bit tempered, same with the same-store sales growth, that the macro environment continues to be something we want to be cautious about. One, as we think about, we have great pricing power, but we want to be careful because it is a fragmented market and customers have a lot of options not to overplay pricing in our algorithm and be tied to doing that in the detriment of long-term growth. So I think similar to what Kevin was trying to outline, we're trying to be conservative. We see line of sight at the top end of the ranges, and we see upside. But we want to be tempered because there are downside risks, and so what you'll see is we've taken both of those into account, and we're laying out commitments that we feel highly confident we can achieve.
Thanks, Lori. Next, we'll turn to a question on our franchisees. Can you discuss how conversations with new franchisees are progressing and provide any color how you expect the base will evolve over the next 3 years? As the system grows, how do you ensure that franchise and company-owned strategies remain aligned and consistent?
Yeah, so I'll start with the first as far as conversations with new franchise partners. As you all can imagine, we're talking to a very diverse group of interested parties. So one, we've got a very high tenured base, and those franchise owners have told us that they care about their legacy, they care about their people. They've asked us to engage various firms that we feel could be great partners if and when they look to exit. So those conversations are ongoing, and there's significant interest there. And then when you get down to more of the traditional family office funds, a lot of times, being the industry leader, I think we've got the advantage where it's less about us selling them. I think they see it in the data, they see it in the performance, as I talked about earlier. It's more about, can we carve out enough, or can we give them enough territory that allows them to expand and meet their needs? So those conversations are ongoing. As I mentioned in my presentation earlier today, we're targeting an incremental 100 to 150 units, and it will come from those new partners that we're talking to. There's significant interest there, and we're excited about bringing in those new partners to help diversify our network and help us generate that roughly 1/3 of the unit commitments. On the next question around how do we ensure that we align on, I believe the question was around margin. What can you repeat the question, Elizabeth?
Of course. As the system grows, how do you ensure that franchise and company-owned strategies remain aligned and consistent?
Strategies remain aligned. Thank you. Yeah, so I think it's more about at the highest level, Valvoline, our primary goal is to drive shareholder value. Our franchisees' primary goal is to be more profitable tomorrow than they were today, right? And those are very much connected. I think the three items I would hit on when we talk about how we generate that alignment. One, it's about a relationship. I think Valvoline is very unique. We're in the business with our franchise partners. We've been working with them many times 25 plus years, so there's significant trust. And I think that personal kind of relationship and commitment we have to each other goes a long way. I think the second thing, and we started doing this around 2 years ago, and I think it's worked really well for us, is we've adjusted our incentives that we have for our franchise partners to ensure they're aligned with our mutually established goals. So we have incentive in place for driving strong same-store sales growth. We have incentives in place for franchisees to remain on top of or ahead of their development commitments, and those incentives are driving win-win solutions and partnerships for both Valvoline and our franchise partners. And the last thing I would hit on is the contractual commitments. So we know how profitable, or how valuable, I should say, having exclusive development rights are. And we structured those agreements in a way where our franchisees can continue to maintain those exclusive rights. But in order to have that, they have to stay on top of or ahead of their commitments. So I would say, again, the three things we use to generate alignment is our relationships, the incentives we have in place, as well as the contractual commitments.
Thanks, Adam. The next question is on our network growth. What does the roadmap to 3,500 stores look like? And how many locations do you believe the market can ultimately support?
So our current pace of growth will get us at 3,500 units sometime in early 2030s. But I think what we're most excited about is the work we're doing around driving down capital costs. And by driving down those capital costs, we see a path beyond that 3,500, and the path is pretty clear. I believe Kevin and both Lori mentioned some things that we can drive growth in their presentations. Lori mentioned that currently we only have 6% market share, so a ton of room to grow and eat more market share as we expand. Kevin also mentioned that only around 40% of the current car park lives within 10 miles of existing Valvoline, so tremendous opportunity to grow that percentage upward as well. With the momentum we've had through Adam's leadership, the commitment from the franchisees to add 50 to 60% of growth going forward, along with over $1 billion of committed growth from them, we see a way to expand growth beyond 3,500 while certainly still driving high return on invested capital.
Thanks, Brian. What role do you see technology playing in driving margin expansion over the next few years?
So much like I discussed earlier, technology is going to be critical to our margin expansion. I gave you some examples earlier around Workday, but let me back up just for a second. When I joined Valvoline, I was extremely impressed with the amount of data that we had. And we believe, and we're pretty clear, that we're leading in this industry around our technology and our data. But compared to other retailers, we still have some catch-up to do. And so I've discussed with you that we've done a lot with Workday, using technology to really dial in where the efficiencies are. And we see using technology to both manage efficiencies and gain more efficiencies out of the box, to actually gain a little more control and or forward forward view of what's happening inside the marketplace. For example, one thing I didn't hint to is our data. We spent a lot of time taking the data that we had and cleansing it and really categorizing it in such a way to where we can quickly get our hands on it and understand the patterns that are happening inside the environment, which allows us to forecast better and understand better when forecasts are off what's occurring. But there's other things we're doing that I didn't share with you. We've rolled out a brand new, really high-tech digital camera systems, about 600 stores last year. We'll finish out this year, that are allowing us to hone into the stores and actually pick up gaps through using the technology, more gaps in our processes. And when we make a change to something, we can actually dial into the stores and see, is it behaving as we thought? Are we returning what we thought we would get back out of these type changes? So whether it be Super Pro that I talked about, whether it be Workday, that I know I exhausted in the presentation this morning on what we still have to gain in labor. We're using eyes in the sky in the stores to monitor and measure the efficiencies that we're expecting. And we've got a plethora of data really categorized in such a way to get our hands on that will both give us insight into what we expect inspect what we expect, as well as use the data to start building out new things around customer propositions and better ways to serve our guests.
And if I can build on that specifically from a marketing perspective, I think technology will certainly play a role in marketing efficiency. It already is. When you think about AI and machine learning, which we already are implementing in our marketing programs, it creates the usage of that data that you referenced in a much more efficient way. And so I'll give you a couple of examples of things that are already happening. Campaign automated bidding, and campaign I can't say the words. I'll start over. Sorry about that. Automated bidding and campaign management, particularly within search, right? That's already happening today. Next best action within our life cycle programs, that's our retention program. So that's helping us to really understand and be efficient around delivering the right offer in the right channel at the right time to the consumer to not avoid waste and subsidy. And then finally, I would say everybody is expecting on the marketing front a reduction in production costs for content creation. And so those are some of the things that we're already implementing, and we're already looking for those improvements.
The next question stays in the marketing space. How do you decide where to allocate marketing dollars to optimize both customer acquisition and retention?
So I think the first thing I would say is we really think about our marketing spend as an investment versus just a spend line item on the P&L. And to that end, every investment we do has a measurement component. Particularly within marketing, we're looking at return on ad spend against every performance channel and every campaign, whether that's acquisition or retention focused, and that's driving decision making. And specifically around acquisition, I would give you an example because a lot of people are skeptical about the return on acquisition because it is more expensive to acquire a customer, obviously, than to retain. And even our highest offer, promotion to try to drive customer acquisition is still driving incremental profit on that first visit. And so those are some of the decisions that we make in terms of the balance of the spend between acquisition and retention. I would tell you again from an efficiency standpoint, as we continue to build on the strength of our brand and now scale to a national level, it affords us opportunities to buy in channels that we couldn't previously at that national spend level. And that will give us the opportunity, again, not only to expose our brand to more consumers from an acquisition perspective, but it also makes everything else from a retention or a demand capture perspective much more efficient.
Thank you, Laura. How is Valvoline addressing the inherent terminal value risk associated with the shift to EVs?
I tried to cover this in the remarks I made earlier. The reality is the time frame with which EVs are going to grow as a percentage of the car park and as of the percentage of the car park that we typically serve, it's a pretty extended runway. We're looking at well into the 2030s before it would start to have an impact if we did nothing. And the reality is we're not standing still. So I think we have done pilots, we have been engaging EV customers. The technology is still evolving, but there are key maintenance requirements, and our asset base, both our footprint, our relationship with fleet customers, and the makeup of our stores, we can leverage our assets to serve EVs. Now, the menu is going to look different, and the way we price that menu will actually have to be fit for purpose for an EV, but everything right now as it's evolving gives us great confidence that we are in a position, both brand and consumer trust in our brand, that we will be able to evolve as necessary over time. It's quite easy to think about in a 2 or 3 bay store. As a car park evolves around that store, you can start to customize a bay to serve a different vehicle powertrain. And so because we can actually start to flex our store base and the bays, and think about each bay is serving specific guests, we can actually make that evolution fairly seamlessly, location by location.
Our next question is on the Breeze deal. On the Breeze deal, it was mentioned the divestitures push this from an A+ deal down to a B or a B+. Is that based solely on locations? And can you walk us through how those locations can get average unit volumes up to about 1.7 million and in line with core Valvoline? How does it fit into this medium-term growth algorithm?
Yeah, great question. I'll let you cover the impact on the medium-term growth algorithm. What I will say is, having to divest the number of stores that the FTC required in an auction-timed process is what really changed the economics from an A+ deal to a B or B+ deal. The amount that we had to pay and then sold those stores for, and I think Kevin was quite clear on the multiple change, is what changed the economics of that deal. And when we talk about a post-synergy multiple of 7, that multiple would have been much less had we not had to divest those stores at the prices that we did. But looking at the store base that we have, it's not like we got rid of the best stores or the worst stores. They were roughly average. We've looked at every single store in their portfolio and run it against our real estate analytics, which has proven to be very robust forecasting mechanism of what our brand, our fleet and marketing capabilities, and our playbook will generate in terms of volume and return. So we've run that real estate model against every single site, the 162 that we've maintained. And we know that there's significant upside on the sales line when you take our marketing playbook plus our fleet penetration in those regions, plus the Super Pro process and technology, which enhances the service experience and the retention rates. We know that we can get it up to the system average. Now, there'll be some stores, particularly in California, which will be higher than that average, and there'll be some in smaller locations that'll be lower. But we feel quite confident that there's a significant upside. That'll drive margin improvement. When you grow a store from 1 to 1.1 million to 1.7 to 1.8 million, that margin accretion is very attractive. There will be other synergies as well as we integrate that business more fully into Valvoline from a G&A perspective. But when we buy those stores, we also invest. We do have to do some investment. They do spend money on marketing, but do not have the efficiency and or the mechanisms that we do to drive the kind of volume. So there will be some investment in marketing. We'll have to invest in technology and training as we integrate them into our portfolio. So there are some investments that we have to make in the short term, and that's the reason why you start with a higher EBITDA, it comes down a bit before it accelerates. That is the process that we use for every independent acquisition, whether it's 1 or 3 stores. We just happen to be taking on 160 over time. And the algorithm that we've placed and the commitments that we're making for FY26 take into account a measured approach for how we integrate that business into ours over time. We're not assuming we can get that all done in a short period of time. We still have a very active pipeline in the core business that we had before Breeze that we'll still want to move against. But it does create return, even with the required FTC divestitures. Want to add?
Lori, I think you covered it really well. As I said in my remarks, we expect Breeze to add about $160 million to our revenue in '26, about $30 million in EBITDA, and that's for 10 months of ownership. As we think about what that means for the medium-term algorithm, I think Lori explained it very well. The short answer is we would expect those 162 stores to act much like any store that we acquire, and we tend to acquire 30 to 40 stores per year. We run the same playbook on those stores. We invest incrementally to integrate those stores into our system, into the training program, et cetera, and then we start to see that ramp year 2, year 3, year 4 as they grow towards maturity. We expect the same thing to come from the Breeze locations that we just acquired.
Our next question turns to our fleet business. On the fleet business, how large is that as a percentage of overall revenues? And can you help us understand the margin associated with that business relative to the overall company margin rate?
Sure. I think Lori mentioned it in her comments. From FY22 to now, we've seen a 17% compound growth rate in top-line revenue for the fleet business, and yet it still only represents less than 10% of our overall net sales. And so, again, that's why we're bullish on the upside of that business. In terms of the margin question specifically, it is higher than consumer, and that's based on a couple of factors. The average ticket, even with a discount for fleet, is higher than consumer. And that's based on the fact that they have a higher attachment rate of non-oil change revenue, and they have a higher penetration of synthetic based on the age of the vehicles that they're driving. And so those factors drive that higher ticket, which in essence gives us the efficiency and labor to create margin. I would talk a little bit about why it's an area of focus and what we're doing, just to build on that, because again, if you look at the fleet, the car park, the vehicles in operation growth as well as the miles driven growth is outpacing consumer. So again, there's a larger opportunity here in front of us based on the share of that business that we have today. And there's a couple of areas that we're really focused on. I would say we have made significant investments and continue to make significant investments in our sales and marketing capabilities and resources to support that business. We are partnering in different ways with the fleet management companies, and we're also partnering with technology companies, as Lenny mentioned, like Auto Integrate, to help drive our capabilities, the way that we can service those customers in the fleet space. The second area is franchise enablement. And so we've really started to expand our ability to help them with their sales capabilities at both a local and a national level so that we can bring the learnings that we've had in our company stores as the franchisor to the franchise business.
Thanks, Laura. Next question. How do you manage net sales and margin performance across the company-owned store system?
Sorry, could you repeat the question, please,
Sure.
Elizabeth?
How do you manage net sales and margin performance across the company-owned store system?
Sure. Well, first of all, robust technology and a lot of robust data gives us direct insight on a daily basis into exactly how each and every store in the network performs. And so we can take very quick action if we see dips in performance. We can also take learnings from our top stores and drive that through the network. We've talked about it before. We do quartiling, but we also do deciling so that we can understand the performance of each and every store in the network. And using the data that Lenny talked about, we can actually tease out what's driving better performance, what's driving lower performance, and apply those learnings really across the network. And that's very, very powerful for us.
I'll add to that. So like any retailer, what Kevin was just speaking of, we dial into the today. We watch stores, we watch performance, we know our top, our bottom, we learn from the top, we apply pressure to the bottom, we understand, is it microeconomic factors or is it operational factors we got to get our hands around? Then there's a longer view that I want to add, is that with the data that I talked about earlier and our understanding of the marketplace, we know what we project performance to be. We know where the rises and falls are throughout the cycle of the car park, annualized over 365 days. We understand what our biggest time periods and time frames are. We watch as the car park evolves and mileage interval goes up, we know what to expect against our customer base. Are they hitting those intervals? And so we actually have the ability too to watch and understand what the business is that we're forecasting, we're projecting, and how that's playing out, to then, if it doesn't, to dig in and understand why and make adjustments to our forecast. So very close control on the day-to-day operations of it, with also a macro view of how it's progressing and how we would apply those changes and the levers that we would pull for the longer-term view of the performance.
Thanks. The next question is on our build cost. How is the team progressing on initiatives to lower upfront capital? The slide describing franchisees' returns indicated that the initial investment was approximately $2 million. Is that what franchisees are currently investing, or is that the level you are targeting? Is the 10% reduction intended to offset likely inflation, keeping the build cost the same?
So I think Brian covered the capital cost reduction to date, as well as going, and then you can talk to the franchise piece.
Sure. So as Kevin mentioned, we've reduced our capital spend on a per project basis by about 10 to 15% over the last couple of years. We do have clear line of sight to pull out another 10 to 15% going forward. So what I'll do, if you don't mind, I'll touch on a few things that we're working on that we've already, to make the box a little cleaner already and to drive higher returns. Number one, we've introduced more two bays into the system. Our two-bay buildings involve a lower upfront capital spend. We build them in a manner that we can expand them to a three-bay, four-bay in the future if the market dictates. Going forward in 2026, you'll see about 60% of our new builds will be those two bays. Secondly, with Adam's support and leadership, we've partnered with the franchise community to really take a new look at our current prototype, really dug in, everything from the specs to the designs, to really create a leaner, more efficient prototype that can deliver some significant savings. What we'll see going forward is the number of builds of this new prototype will increase exponentially from 25 to 26 to generate a lot of savings there. We are also, which is exciting, working on a new prefab model that we'll pilot in 2026. That will do a couple of different things. That will not only increase speed to market, but it will greatly reduce the spend that we spend with contractors. And then lastly, we're working on another design to reduce the square footage of our basements to drive costs even lower. So we're really of the mindset of lowering and addressing capital spend while not compromising customer or employee experience.
Yeah, and I think on the franchise side, one thing I'll say before Brian got into the organization, development was very much handled in isolation, meaning company was kind of focused on our own development opportunities. Each franchise system was focused on their own, and there wasn't a lot of collaboration, there wasn't a lot of sharing, and that's changed over the years. We now have a development council, we're actively meeting, and as you can imagine, our franchisees are very entrepreneurial in spirit, and they continually work with us and look for ways to lower capital costs. I think when we're talking about capital costs, it becomes challenging, right? Because across regions, there are certain local and regional requirements that are going to drive certain costs up, et cetera. But we are seeing costs from some of our franchise partners in certain markets below the $2 million that was initially quoted.
And I'll just add that we're early on in the Breeze discussions. With the FTC review, we couldn't get into anything competitively sensitive. But in the last 2 to 3 weeks, we've been really encouraged by the oil changers team and their site design and cost. And therefore, whenever when we buy small acquisitions, these are not small operators that are building stores, but oil changers has been buying and converting and building stores. And so it's a fresh chance for us to look through what they're doing that we could actually port into our network. The other thing that they've had good success on is build to suit. So they have a couple of build to suit partners where they lower the capital costs consistently, very considerably with a high rent expense. And this is something that we have been trying to build some capability and partnerships for, because we have small franchisees who do not have the size in order to have a dedicated real estate development team to manage those projects. So by giving them a build-to-suit partner, not only can they lower the upfront capital cost, but they have a turnkey solution with which to add units. In our last 2 franchise workshops, our smaller franchise partners, they may have 5 to 10 units. they have been asking for more solutions and more support so that they can double their units within their smaller systems. So I think some of what we're seeing within the Breeze Oil Changers team is pretty exciting and will lead to more potential for us.
Lori and Kevin, the next question is directed to you. From your perspective, why hasn't this been a better performing stock? And what do you think the market most misunderstands about Valvoline?
I'll start. Having been here 7 months, one of the things that, again, I was just so impressed with when I joined is the team and the quality of the business. I think as I look at it, and I said this in my remarks, I think there may be 3 things that contribute to what I would call a misunderstood company. It's an exceptional company that is underappreciated, let's say. Number one, a lot of change has occurred since the separation of the products business. Investments have been made to really set a foundation for growth, and I don't think the market really appreciates the value in that. Focused more on the now, not on the future. I think the second thing is the 3 refranchising transactions happened very close together. That wasn't originally the plan. Lori can talk to that, but those ideally would have been spread out more, but they did happen very coincident with one another. And I think that created a lot of noise in the system. While those will create value, those transactions will create value because of the development agreements that came with them. I think that contributes to, call it an underappreciation of the company and the potential. And I think the third part is the overhang from that extended Breeze transaction. I mean, that deal was announced in February. We just closed it a couple of weeks ago. I think that creates some overhang. Hopefully, by what we've been able to show you today, tell you today, and maybe most importantly, commit to today, you can actually see that there is an incredibly bright future for this company and this organization that should translate into a much higher multiple and a much higher value from a stock price performance perspective.
Yeah, I'll just add that apart from Breeze, everything that we have done since we became a pure play retailer, we've been talking about. So we talked about wanting to agitate franchisee unit growth because we were underpenetrated, not just in the company markets we operated, but on the franchise side. And we needed to increase the development commitments that they were putting, which we have done, and I think Adam demonstrated that pretty well. We talked about franchising white space markets. We've done that. We've brought in partners like CMG and another couple in areas that weren't being developed at all. We talked about bringing in new capital to back existing franchise partners who had stopped developing because of where they were in their time horizon and career. We've done that with companies, in the middle of the country. There's still more in discussions and underpin the additional opportunity that Adam talked about. And we talked about the potential for refranchising. So all of the things we've said we were going to do, we've done. I think the refranchising piece came much faster than we thought because there was such demand, and the demand came from the economics and the returns that Adam shared relative to QSR. But it came very quickly, and I think our misstep was we were not as transparent in disclosing the information around those transactions to make it easier for you to follow the underlying business momentum versus the impacts of refranchising. I think as we look at Breeze, obviously with the FTC required divestiture, there would be concerns around how much value can be created. Our intent today was to share more information on that, to share our commitment around what the business will do and how much upside there is. So I think part of this is us learning around how to provide more information so that investors can truly look at the business performance and hold us accountable.
Lori, one last question for you. What would you like investors to take from today's update?
I think it's a pretty simple message. One, we are the category leader, and we have built amazing moats from an asset and a capability standpoint that we have built over time, but that have also delivered industry-leading performance and will continue to do so. Two, there's still a lot of upside in our business, whether it's the margin expansion that Lenny talked about or the network acceleration or network growth, footprint growth, and the acceleration on the franchise side for new unit delivery. I think those things will drive profit faster than sales, profit growth faster than sales over the medium term. And that combined with disciplined capital allocation will lead to top shareholder returns. So I think as you step back and look at where we stand today, we've done a bunch of the investment. Some of the lumpiness of the refranchising in Breeze it will now move up, continue to move forward from that. And as you look at 27 and 28, it will be a very attractive, high profitable, and high cash growth generating business. So we think it's a great investment opportunity.
Thanks, Lori. This concludes our presentation today. We appreciate your interest in our story and thank you for joining us.